In 2008, JPMorgan Chase filed a secret warning about Bernie Madoff with financial regulators in London, not New York. And when the scheme collapsed weeks later, erasing $17 billion in real savings from 37,000 victims, not one JPMorgan executive was ever charged with a crime. So why has no one ever told you that part? Jamie Dimon runs the most powerful bank in America. That's the version of the story you know. Steady hands, sound judgment. The one Wall Street CEO who seemed to actually understand risk while everyone else was burning. JPMorgan Chase holds $3.7 trillion in assets. It survived 2008. It bought Bear Stearns at the federal government's request and walked away looking like a rescuer. For over a decade, the narrative in every business publication was the same. JPMorgan is the responsible one, but here is what they left out. For more than 20 years, Bernie Madoff ran his money management operation through one primary institution. One account. One bank that saw every deposit, every redemption, every wire transfer flowing in and out of the largest Ponzi scheme in American history. That bank was JPMorgan Chase. And by 2006, 2 full years before the arrest, people inside that bank were already raising alarms. Internal emails uncovered by federal investigators show JPMorgan employees openly questioning whether Madoff's returns were even mathematically possible. One analyst noted the strategy he claimed to be running could not produce those results. The trading volume he reported to clients didn't match what the exchanges actually recorded. These concerns were documented, they were escalated, and then they disappeared. In October 2008, just weeks before Madoff confessed to his own sons, JPMorgan filed what's called a suspicious activity report, a formal legal document stating the bank believed fraudulent activity was occurring with Madoff's funds. They filed it. They actually took the step, but they sent it to financial regulators in the United Kingdom. The account in question held $483 million. The account was in New York. The victims were mostly American. The warning went to London, but that's not even the part they really didn't want out. The U.S. Suspicious Activity Report, the one filed with FinCEN, the one that triggers a federal investigation, the one that might have stopped it, was never submitted. Not in October, not in November, not before December 10th, when Madoff called his sons into his apartment and admitted he had been running a fraud for decades. JPMorgan had the legal obligation to file in the relevant jurisdiction. They had documented internal warnings going back 2 years. They chose London and said nothing in New York. Here is why that matters. Madoff's fraud had been running since at least 1991. When the collapse finally came, 37,000 investors opened their account statements and found nothing. Pension funds for retirees, charitable foundations, Holocaust survivor advocacy organizations. Families who had trusted Madoff for a generation. The actual cash stolen, real money, not inflated paper values, was $17 billion. And throughout every year of it, one bank processed the deposits and collected the fees. JPMorgan earned hundreds of millions of dollars from Madoff's accounts over the life of that relationship. They were not a passive middleman. They were the infrastructure. Now here's the part nobody talks about. The executives who reviewed those 2006 internal emails expressing doubt about Madoff's strategy were never publicly identified. They didn't lose their jobs. Their bonuses weren't clawed back. When JPMorgan settled with the Department of Justice in January 2014, they paid $2.6 billion and signed a deferred prosecution agreement, a legal structure where the institution admits failure and the individuals who actually made the decisions walk free. Not one person was named. Not one person was indicted. The corporation absorbed the consequence, and the human being who decided to file in London and stay silent in New York was never held to account. $2.6 billion sounds like punishment. For JPMorgan Chase, it was 11 days of net income. They reported $21.3 billion in profit that same year. The deferred prosecution agreement expired. No trial. No executive under oath explaining why the report went to the UK and not FinCEN. The case closed. JPMorgan reported record earnings the following quarter. Now go back to October 2008. That report. That decision. Someone chose London over New York. That is not a clerical error. That is a deliberate routing decision made by a person in a position of authority at one of the most closely monitored financial institutions on Earth. That person's name has never appeared in a headline, and under the structure of the deferred prosecution agreement, it likely never will. JPMorgan Chase still holds $3.7 trillion in assets. Jamie Dimon is still described in major financial publications as the most trusted CEO on Wall Street, and whoever decided to file that report in London is still out there. which means the only real question isn't whether this happened. The question is, if a bank can process a $17 billion fraud for 20 years, file a warning in the wrong country on purpose, settle for 11 days of profit, and protect every single person who made that call, what exactly would it take for someone in this system to actually face consequences?